The markets have been going through some tumultuous activity, to say the least. Here to tell us what they see and what they're looking at right now is Michael Craig. He's head of asset allocation at TD Asset Management, and Scott Coburn, managing director of global fixed income at TD Asset Management. I want to start with, and I know you have some ideas of the things that people should be thinking about in this market, just how to manage through all the volatility. But let's just start with the why. Why is the market behaving as it is right now, Michael?
Okay, so there's been two really big shocks that have occurred over the last 10 days. Of course, COVID-19, and that is slowly moving in different phases throughout parts of the world, and now it's hitting North America. And obviously North Americans are now becoming much more sensitive to something that I think was somewhat dismissive a week or so ago. The second thing is that we have now an oil price war instigated by the Saudis on the weekend. It feels like old news now, but this has really led to stress in credit markets because there's a huge amount of corporate bonds that are energy issuers, and both the shale and the oil sands are in a lot of trouble because oil, these prices, those firms just aren't making any money.
And and we'll get to fixed income in just a second, Scott, but what has this meant for equities in terms of how they're behaving?
So markets hate uncertainty, and there's a tremendous amount of uncertainty. There really isn't anything to benchmark this against historically. And right now, the market's looking for leadership and action from policymakers, and you really haven't seen anything of any size yet that's going to calm the market. So the markets will continue to riot until they get what they want, and that is concrete action, but we just haven't seen it yet. And so until that time, it's going to be tremendously volatile.
I want to come back to the concrete action, but let's just go to the fixed income side too. What are you seeing on that side of the market? Because I know, you have schooled me many times and talked to you both in terms of not all fixed income instruments are equal. Right. So what are we seeing?
You've seen a tremendous rally in government bonds. So at the end of last year, you've had a rate, government bonds, 10-year government bonds have rallied about 100 and 120 basis points since that time in response to the two shocks that Mike has talked about. On the other side of it, on the investment grade government debt, and even more so on the high yield side, spreads, the spread relative to the government bonds have widened over that course of time, doubling, in fact, in both high yield and investment grade debt. And so that reflects the stress in the funding markets, in particular on the energy side. So it's been bifurcating in the market. Fixed income is doing what you're supposed to do, particularly government bonds. It's an offset to the equity volatility. So if you had a diversified portfolio, it's doing what you want, but not all fixed income is the same. And so investment grade and high yield debt are underperforming.
So let's talk a bit about just what diversification means, because what I've heard in the past little while, some people think or are doing things that perhaps they think they're diversified, and then when they look at their portfolios in situations like this, they realize that they're not as diversified as they thought, perhaps because of the types of things they have in there right now.
Yeah, so we build these mousetraps, and in certain periods of time they work great, but you really never know how well you built a portfolio until it's stressed under very, very intense conditions like we are going through right now. I think the challenge many people are realizing is that they hold equities, which of course suffer in periods like this, but the type of fixed income they're using isn't working as well as they'd want it to. Really, the only fixed income that's really working well right now is treasuries, whether they be Government of Canada's, US Treasuries, bonds, etc. That is the one slice of the fixed income market that's really performing well and has served as a phenomenal diversifier. You don't have a lot of yield in these things, and you're never going to be able to retire by the returns you get from the income from government bonds because they are so low. But not just like when you buy insurance on a house, when your house burns down, you want to have that insurance to pay to rebuild it. And that's how you should be thinking about treasuries. They are a form of insurance and a form of diversification. And many managers have decided to move away from them because of those low yields and are unfortunately now are feeling the pain of that.
So in the short term, is that people just need to re-examine, I guess, the composition of what's in there and making sure that the parts that are supposed to be doing the things that they're doing are actually doing that?
Yeah, you're being exposed to that composition that Mike said. We've been in a 12-year bull market. It's been easy just to buy carry or that spread, corporate debt, high yield debt. And then when you get into these shocks, you realize that it's not going to provide you as much diversification because you're sort of focused on the illusion of just saying income is low, so I don't need these things. But in fact, as you've seen, bond yields can go negative. So even a yield at 1.5 or 2% can go to 1, can go to 0. In response to policymaking, which we've seen the Fed and the Bank of Canada early days.
Okay, so I want to pick up on that. You talked about what the central banks are doing from a monetary standpoint and the need for concrete action. What does concrete action look like from your standpoint?
It's almost a triad of actions. One, you will likely see rates cut. Second, looking for real fiscal support from governments. And the third is a better response on the healthcare side. We are going to see a lot of people getting sick. People are quite afraid. Workers are scared. And so more clear policy, and this is a global thing, not just Canada or the US, how we're going to cope with this, which is going to put on some tremendous stress on our healthcare systems.
What about things to keep in mind? I keep going back to, there's other ways I think people have talked about for diversifying, in terms of treasuries right now, you said doing what they're supposed to do in terms of maintaining that protection of principal. But what about, alts and like low vol solutions and other things? How do those play into this right now? Because a lot of things are moving together.
Yeah, so I'm going to speak to that on a shorter term and a longer term. So shorter term tactics, what we've been using has been using option strategies, puts on the equity markets, which are a form of insurance. We've been increasing our exposure to things like the US dollar and currencies that are typically used for funding, like the Japanese yen. And the third is also ultimately using longer term treasuries as a signaling tool. As they fall, the market's telling you that we're expecting lower growth, if not recession, coming forward. So that's a very tactical decision. As you look forward on a more of a structural basis, this is where alts become quite valuable because when you think about using real assets, they have generally a positive return stream, high single digits, and they are very uncorrelated to public markets. And so in times like this, portfolios we use on the institutional side have done very, very well because of the alt exposure, and has really been a shock absorber in this incredibly volatile period.
Last question for both of you. When somebody's watching this and we're talking about managing through volatility, what are some of the key things I think you have to keep in mind?
Well, you're looking for indicators of policy response, right? Obviously, if you've had a balanced portfolio, you're going to be wanting to rebalance away from the insurance part of your portfolio into equities, alts, and so you're looking
at the levels we're at now.
Yeah, I think you start thinking about it both from a shorter term point of view, but you haven't seen that, as Mike said, the triad of responses. You've just seen predominantly the monetary policy response. Okay. So you're looking for that to improve over time, to continue to signal a rebalancing of your portfolio into the other parts of the riskier assets, the equities and the alts.
Mike?
I've been asked this client question a few times, when do I buy? And I'll give you this similar answer. The markets have obviously cheapened up a lot, and they've discounted quite a bit of slowdown, if not recession, already. So we're getting to prices that are highly attractive for longer term investors, but we still think that because we haven't seen real concrete action yet, that we're likely to see lower prices in the days to come.
All right, Mike, Scott, thanks for your time today.
Thank you.
Thank you.